The information provided on and made available through the Macro Business website does not constitute financial product advice. The information is of a general nature only and does not take into account any individual objectives or specific financial situations. It should not be used, relied upon, or treated as a substitute for specific financial advice. Macro Business recommends that all investors obtain their own independent professional advice before making any investment decision. Macro Business does not guarantee the accuracy, completeness, or currency of any information provided on or through this website. Welcome to the Macro Business Trading Videocast. This afternoon I'm talking with Macro Business investing strategist Chris Becker about how he's seeing today's trading conditions and some of the trades he's seeing in the equities markets. Chris, thanks very much for your time. Can we go first to your macro backdrop? It's been another very tough day for Australian stocks with global volatility playing a part. How are you seeing the risks?
We have to place this into context. The market has got ahead of itself in recent time, and I first want to just take a slow look at the monthly chart of the broader market just to see where we are. So the chart I've got up here is going back a few years to the GFC, and you can see that since we've been in this very broad trading range, and the last couple of months we've extended above the psychologically important 5,000 points, but this has been an extremely fast trend, and what we're really looking at here is, if I just turn an overlay on this chart, there's a green line on the chart now, and that's the financial sector. This is very important because the financial sector, which is the banks, insurance, that sort of thing, is now 45% of the market, so effectively is the market, and it's extremely overbought ever since the RBA started easing rates aggressively.
Okay, does that mean you're looking for a correction in banks and financials, and if so, what does that mean for the wider ASX?
There could be a correction in banks, and that's the problem. The market has some breadth with certain dollar-exposed industrials, a couple of consumer stocks and defensive stocks on a chase for yield, but the real problem we've got here is the financials, because they take up so much of the index. If they falter, if they just have a small dip, the entire index could go down quite a lot. And the other sector that people are saying should fill the gap, the materials, is actually in a bear market. So I'm just going to quickly look at the materials sector and see what's going on there.
The materials have had a pretty tough year. There's actually been quite a few traders talking about rotating out of banks and financials and into them. So what are your thoughts?
Yeah, that's true. That seems to be the mainstream view. And you can see from this chart I've got here, a weekly chart of the materials stocks. They've been in a bear market for 2 years now, and going to new lows. The sector itself is down to about 9,000 points. On this chart I've overlaid what I consider the best Chinese share market to follow, the Hang Seng China Enterprise Index. And you can see it's extremely closely correlated because, for want of a better word, commodities is China and China is commodities. There's been a divergence in the last couple of months where we've seen China markets have had a small correction, whereas the materials has fallen off quite sharply after having a small rally halfway through last year.
What's that divergence actually telling us?
That divergence is telling us that, as we saw today with the capital expenditure accounts, there doesn't seem to be a lot of faith in earnings power potential, I would say, going forward for the materials sector. And even though a lot of the risk has been taken out of the price, and indeed some of the stocks, and one of them I'll talk about shortly, some of the yields aren't too bad, there are a lot of risks around materials, and that's because China is slowing down, which is fine for China, but that's not good enough for our local material stocks. And
what are you specifically looking for in this field in terms of risks and opportunities, really?
Well, there is still an opportunity here to buy materials, and as we can see on the chart, they've bottomed out around 9,000 points. Now, the way I look at materials is I always look at the Chinese stocks first, because they usually lead ours, and also most of our stocks are listed on the London market as well. So what I'm looking for is there is a small rally, a small trend line going through with the Hang Seng China Enterprise Index, but that has not followed through. This dip is still mainly on the back of the Japanese stock market. It's still a little bit too volatile. So what we're looking at here is the HSC needs to break out well above 11,000 points to get any momentum, and that equates to about 9,600 points on the materials. Until that time, I would only play this as a breakout.
And when we're talking about either the financials or the materials, what sort of specific trades are you looking at the moment?
Well, going back to the financials, and this is where there could be one of the best trades this year, I've got out the chart here of the finance sector itself with the overlaid, I've overlaid the ASX 200 there in green. Now just quickly, I'll just show you this is a semi-logarithmic chart. What that means is each price rise is identical. So going from 4,000 to 5,000 is the same as going 5,000 to 8,000. And even on this chart, it's parabolic. It's quite clear. This has been an extremely fast rally on the bank stocks. The problem is they are poised right now to correct. So that's what I'm looking at to start with. Is there's a possibility here to short this sector. The risk reward on shorting the whole sector might not be as good as specific banks. So that's what I'm looking at next.
Big banks?
No, I don't think so, not yet. When you're shorting sectors or when you're shorting a stock, you really should be looking at the weakest. So the big banks, as much as they do have a lot of risk, and I disagree quite a lot with the mainstream brokers about the banks, the consensus view is the big banks, particularly Commonwealth Bank especially, are relatively safe. So you've got to be looking at the weaker ones, and the weakest by far is Bank of Queensland. And I've got the chart up here at the moment about what's potential here. The Bank of Queensland has formed quite a big top on the charts and has broken through support in this week. And it looks like people are selling this one off as opposed to the other major banks. I'm looking here, there's a possible shorting opportunity from $9 all the way down to $6.50, believe it or not. This one is actually, for mine, it's a fairly easy setup because there's a natural resistance level there at the psychologically important $10. And so if we short that going into any strength, any rebounds above $9.20 and all the way up, that sets up a pretty good risk-reward trade. So that's quite an easy one to manage.
Something for the investors to think about. And what about in materials?
In materials, there's 3 or 4 that I'm looking at very closely. The first one I'll start with is Fortescue, because on the back of some quite volatile iron ore activity in the spot market, Fortescue's been a very profitable trade for both short-term and long-term traders. And it dropped, I believe, 6% today on the back of the iron ore drop.
That'd be the iron ore price, yeah.
That's right. I mean, the thing has to remember with Fortescue, 6% drop sounds like a lot in one day, but actually for a stock like this and some of its other iron ore partners like Atlas Iron, that's actually quite normal. So you have to be willing to ride the volatility wave on this one. What's happened here is we've had quite a sustained downtrend since February this year, and the market is the stock is trying to push itself back above this trend line here that goes from the March down to now. It's down about $3.70, this resistance level. And it's bouncing along about $3.30 on support. What that tells me is there is potential here for it to rebound on the quite high volatility and to set up another shorting opportunity, because if it breaks $3.30, it's most likely to go straight down to $3. The problem with FMG, of course, is the risk reward. It may have done all its dash. You know, I've been shorting this from $5 all the way down. I shorted on all the rallies as a positional short. So as a short-term short, as confusing as that sounds, it may not be the best trade.
What about the giant of the sector, if you like, BHP? A lot of the mainstream press has been talking about getting out of financials and going into, when they talk about materials, they're often talking about just purely BHP or maybe Rio.
Well, BHP by far is the least risky of all the material stocks. It does have an iron ore exposure, which is a big concern, but nowhere near as much as Rio and, of course, FMG. The problem I've got with BHP, as much as technically the setup, and I've got the chart open here, it's approaching the $35 resistance level. The upside potential in terms of capital growth, I think, is very limited, and this worries me for the index as a whole and if you're a long-only investor. So we could see a breakout here above $35. It's been quite volatile the last 2 or 3 weeks, which tells me it's consolidating and it's getting ready for a volatile move up or down. So I'm watching for a breakout above $35. What's really interesting is, in comparison to the banks, right now, BHP's got a trailing fully franked dividend yield of 5%, which is not too bad, not as much as the banks at 7+. But if the Aussie dollar falls another 5 cents or so, that goes to 6%. So there is a potential here for this to be a yield play, as funny as it sounds, and not as much as a capital growth. So you have to pick your battles for that one.
Something else which always attracts a lot of attention is gold. Of late, there's been a big sell-off in the global gold price, obviously, but there's also been a sell-off of late in the Australian dollar. So how do those two match up?
Yeah, gold's a real bad one for those who've held on to it for the last couple of years. From memory, the gold index, the All Ordinaries gold index, is off 66% from its high. There's been a huge divergence between the gold price and Aussie dollar and the local index, which can't be really fully explained. So there is a potential buying opportunity here. However, it could be a case of catching falling knives. I've got the chart of Newcrest up here at the moment, which is effectively the index. It's absorbed most of the younger players. There's also Kingsgate, KCN as well. The problem with this Even though as enticing as it looks, and I've got a potential 3-point rally that could occur in the next few weeks, if the gold price does break out, I don't like buying stocks when they make new lows, and Newcrest is off 60-odd% from its high. It's making new lows again. But we could see a violent upswing. If it can break this downtrend that we've had since the middle of March, it could approach its former support level up at $21. So the risk-reward here can be extremely high, but it's a very risky trade in of itself. And the major problem I've got with this, of course, is the US dollar is really still battering gold around. So maybe we can talk about that another time.
Indeed. Chris Becker, thanks very much for your time.